Berkshire Hathaway's story began not on Wall Street but amidst the whirring looms of New England's textile mills. Founded in 1839 as the Valley Falls Company, it later merged with Berkshire Cotton Manufacturing Company in 1929, adopting the latter's name. The company thrived initially, producing quality textiles and riding the wave of industrial growth. Its mills, scattered across Massachusetts, hummed with activity, supplying fabric for everything from clothing to home furnishings. The company's success was a testament to American entrepreneurial spirit and manufacturing prowess. However, the post-World War II economic landscape proved challenging for Berkshire. The demand for textiles waned as cheaper synthetic fabrics flooded the market. Berkshire's management, slow to adapt to these changing dynamics, clung to traditional practices. The company faced declining profits and a shrinking market share. Its once bustling mills began to fall silent, a harbinger of the challenges to come. The decline of the American textile industry was a complex saga driven by multiple factors. The rise of synthetic fibers, cheaper to produce and offering greater versatility, eroded the demand for traditional cotton textiles. Overseas competition, particularly from Asia, further intensified the pressure. Labor costs in these emerging economies were significantly lower, making it difficult for American manufacturers like Berkshire to compete on price. The textile industry's struggles had a profound impact on communities across New England. Mills that were once the lifeblood of their towns shuttered, leaving behind unemployment and economic hardship. Berkshire Hathaway, despite its long history and reputation for quality, was not immune to these forces. The company's financial performance deteriorated, and its future appeared increasingly uncertain. In the early 1960s, a young Warren Buffett, already making a name for himself as a shrewd investor, took notice of Berkshire Hathaway. He saw an opportunity in the company's undervalued stock, recognizing that its assets were worth more than its market price. Buffett began acquiring shares of Berkshire, initially viewing it as a classic cigar butt investment, a company with one last puff of value left to extract. Buffett's investment philosophy, rooted in the principles of value investing championed by his mentor Benjamin Graham, emphasized identifying undervalued companies with strong fundamentals. He believed in buying businesses, not just stocks, and holding them for the long term. Berkshire Hathaway, despite its troubles, presented an opportunity to put these principles into practice. Initially, Buffett intended to improve Berkshire's textile operations, hoping to revive its fortunes. He invested in new machinery and streamlined processes, but the industry's structural challenges proved too formidable to overcome. The textile business continued to struggle, and Buffett realized that a different approach was needed. Instead of pouring more resources into a declining industry, Buffett began using Berkshire's cash flow to invest in other businesses. He sought out companies with strong management teams, durable competitive advantages, and the potential for long-term growth. This marked a pivotal shift in Berkshire's trajectory, transforming it from a textile manufacturer into an investment holding company. Section 5, the Buffett Touch: Value Investing and Acquisitions. Warren Buffett's investment strategy, often described as value investing, played a crucial role in Berkshire Hathaway's transformation. He sought out companies that were undervalued by the market, possessing strong fundamentals and the potential for long-term growth. Buffett's approach was characterized by patience, discipline, and a deep understanding of businesses and their intrinsic value. Acquisitions became a cornerstone of Berkshire's growth strategy. Buffett targeted companies with strong brands, loyal customer bases, and a history of generating consistent profits. He preferred businesses with simple, easy-to-understand business models operating in industries with high barriers to entry. This approach minimized risk and maximized the potential for long-term returns. Section 6. Insurance: a foundation for financial fortitude. The insurance industry became a cornerstone of Berkshire Hathaway's portfolio. Buffett recognized that insurance companies, by their nature, collect premiums up front and pay out claims later. This float provided Berkshire with a substantial pool of capital that could be invested for the long term, further fueling the company's growth. Buffett's first major acquisition in the insurance sector was National Indemnity Company in 1967. This acquisition provided Berkshire with a platform for growth in the property and casualty insurance market. Over the years, Berkshire acquired a diverse portfolio of insurance businesses, including Geico, General Re, and National Reinsurance, solidifying its position as a leader in the industry. Section 7. Diversification from Geico to Coca-Cola and beyond. Berkshire Hathaway's portfolio expanded beyond insurance to encompass a wide range of industries. Buffett's investment philosophy remained consistent: seek out undervalued companies with strong fundamentals and a durable competitive advantage. This led Berkshire to invest in a diverse array of businesses, from consumer goods to railroads to energy. One of Berkshire's most famous investments was in Coca-Cola in the late 1980s. Buffett recognized the iconic brand's global reach, strong customer loyalty, and consistent profitability. Other notable investments included American Express, Gillette, Wells Fargo, and Burlington Northern Santa Fe Railroad. This diversification across industries mitigated risk and provided multiple avenues for growth. Section 8. The power of patience, long-term vision, and value. Warren Buffett's investment approach was characterized by patience and a long-term perspective. He believed in buying great businesses and holding them for the long haul, allowing compounding to work its magic. This contrasted sharply with the short-term focus of many investors who sought quick profits from market fluctuations. Buffett's patience and discipline were evident in his investment decisions. He was willing to wait for the right opportunity, often sitting on large cash reserves until a compelling investment presented itself. This long-term vision, combined with his ability to identify undervalued assets, were key drivers of Berkshire Hathaway's success. Section 9. Succession and Legacy, the future of Berkshire Hathaway. As Warren Buffett entered his later years, questions about succession and the future of Berkshire Hathaway became increasingly prominent. Buffett had always been deeply involved in the company's operations, and finding a successor who could replicate his unique investment acumen and leadership style was no easy task. In 2010, Buffett announced that his son, Howard Buffett, would succeed him as chairman of Berkshire Hathaway, while the role of CEO would be split. This move aimed to ensure a smooth transition and preserve the company's culture and values. However, the specific individuals who would assume the CEO responsibilities remained undisclosed, adding an element of mystery to the succession plan. Section 10. Lessons from the Oracle: Buffett's enduring wisdom. Warren Buffett's investment philosophy and business acumen have earned him the moniker the Oracle of Omaha. His insights, often shared through his annual letters to Berkshire Hathaway shareholders, have become legendary in the investment community. Buffett's wisdom extends beyond the realm of finance, offering valuable lessons on leadership, ethics, and the importance of long-term thinking. One of Buffett's most enduring principles is the importance of integrity. He believes that ethical behavior is essential for long-term success, both in business and in life. Buffett also emphasizes the power of compounding, both in financial returns and in personal growth. He encourages individuals to invest in themselves, acquiring knowledge and skills that will pay dividends over a lifetime. Section 11. Berkshire Hathaway today, a colossus of capitalism. Today, Berkshire Hathaway stands as a testament to Warren Buffett's extraordinary investment prowess and the power of long-term compounding. The company's diverse portfolio, spanning insurance, energy, railroads, consumer goods, and more, generates billions of dollars in revenue annually. Its stock price, once languishing in the double digits, has soared to astronomical heights, making Berkshire Hathaway one of the most valuable companies in the world. Despite its massive size, Berkshire Hathaway retains a culture of prudence and value investing instilled by Warren Buffett. The company's decentralized structure empowers its subsidiaries to operate autonomously, fostering entrepreneurship and innovation. As Berkshire Hathaway enters a new chapter, its future remains bright, guided by the enduring principles of its legendary founder.